All right, happy Monday, everyone. Welcome back. Going to give it a second for everyone to log in, and then we'll get started on our way. Today, we will be looking at wedge and triangle patterns for another wonderful Monday webinar. Like I said, just going to give it a second here, give everyone a fair chance to log in, pull them over from the waiting room. We'll jump into our disclaimers, and then we will get into the good stuff. Okay, throwing some disclaimers on screen, guys, getting them out of the way. First one I'll read, the next few thereafter. Just read through them quickly on your own, screenshot them, read them later. Do what you want with them, but they are there for you. Hold on. Alrighty. Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade doesn't accept any liability for loss or damage as a result of reliance of the information contained herein. This includes educational material, price quotes, and charts and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade doesn't retain responsibility for any trading losses you might face as a result of using the data shown on its websites or webinars. The data and quotes contained may not be provided by exchanges, but rather by market makers. So prices may be different from exchange prices and may not be accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell or a solicitation to buy or sell futures, options, bonds, or binaries or securities of any kind. The information, the strategies, and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to another party without the express written consent of Earn to Trade LLC. Any trademarks or copyrights reference other than Earn to Trade are the property of the respective holders and not Earn to Trade LLC. Okay, moving along, guys, throwing another one on screen. Once again, please feel free to read right on through it. And I will be trying to get through these as quickly as possible, but giving you a fair shot to read them. Like I said, read them now, screenshot them, read them later, do what you will with them. Moving along, throwing another one up. And another, just one more after this one, and then we'll be on the way. Final one, folks. Final one. Alrighty. So, welcome back, everybody. Happy Monday. Hope everyone's having a great Monday, getting the week started off right. Hopefully, everyone had a wonderful weekend. Today, we are going to be bringing on a presentation about wedge and triangle patterns. I'm going to be discussing these wonderful patterns. They're very popular. Sure, you've probably heard of them. Maybe you've never really looked into them. But if you are interested in wedge and triangle patterns, then this is going to be a treat for you. They are quite fun. They're great. In my opinion, they're great trading patterns. They've been around for a while, and they can be very reliable with, generally speaking, strong reward results. Naturally, being you'll see why once we get past what they are how they are, and how we place our target, our take profit goals, as well as our stop losses based on them. You'll understand what I'm saying there. So same as all of our webinars, we like to keep it casual, have a good time. If you have any questions as we go along, please feel free to type them in the chat box. I will do my best to answer them as soon as possible. However, I may not answer them right away. If I feel like I'm in the flow, or I know that it's something that I have planned to say coming up here will answer your question a little bit more organically, then I might not answer your question right away. Don't panic. You don't have to retype it. I promise. I will make sure I do my best to answer every question asked in one fashion or another. But like I said, ask it, have a good time, relax, casual, no big deal. We're here to learn, have some fun, and yeah, let's get going with it. So today we're going to talk about wedge and triangle patterns. The first half, I'm going to discuss all of the, I guess, more boring side of things. It's gonna be more of a listening portion of the session. We're gonna talk about what they are, what they look like, how to find them, and what have you. Then we're in just the generalized trading theory behind them. And then after that, I'm gonna go ahead and actually draw some on screen. Hopefully, find some great examples for you live on live charts. That is. But if we can't, it doesn't really matter. I'm gonna be able to draw them for you anyway. So we'll be able to get you all set to go here. So without further ado, moving on to the wedge and triangle patterns. Switching over for this portion of the session, guys, I will switch over to, currently I've got the euro dollar open. So we're going to switch on over to that off of the title page here. So 1 second. There we are. So if you have never met me before, I don't want to be rude. I want to go ahead and start off by introducing myself. My name is Chris. I'm a trader and mentor here at Earn to Trade. I am responsible for all of these wonderful Monday webinars that we do. I also do the daily recaps. I'm a mentor as well, like I said, and I do a good portion of all of our educational material as well. So you probably have heard my voice at one point or another and just never realized it. But that's a little bit about myself. I am a trader myself as well, and I enjoy educating even more so than trading, because I feel more gain from watching other people succeed than I feel more pride in that than personally succeeding myself with no one else gaining from it, so to speak, besides myself. But that's how I got into this, and yeah, if you want to introduce yourself, feel free to type in the chat box. I'll definitely read through it while we're going along here. But the goal of this webinar is quite simple. We want to continue expanding our knowledge of trading and learn about triangle and wedge patterns on these live charts, while we show you how to understand, identify, and utilize these areas in real time. After the webinar, my goal for you is that you should be able to begin finding these areas on your personal charts quickly and easily, or at least begin practicing finding them and practicing utilizing them. Everything takes time, and as with anything, practice does make perfect, and the more it makes perfect. But the more you associate yourself, the more time you put into looking and utilizing these concepts that we're about to talk about, the better you're going to get with them. I firmly believe anybody can learn it. Some people learn quicker than others, but don't ever be deterred. But we're going to start off by discussing triangles, and then we're going to work our way into the wedges. They are very similar. You'll understand by the end of this what the differences of them are. But yeah, I suppose triangles have a little bit more depth behind them, mainly speaking because there's 3 main different types of triangles. But so anywho, so starting off with triangles, okay, this is the point where, like I said, I'm going to be doing a lot of speaking. It's not going to be too much visual in the beginning. So if you have a notepad out or you want to take some notes, I strongly recommend it. If you need me to slow down at any point, definitely feel free to ask. But if no one says anything about the speed that I'm going at, I'm just going to keep trucking along and think that, and I'll assume that you guys are keeping up. So feel free to let me slow down and repeat, or tell me to repeat things if I need to. I won't be angry. Won't bite your head off. But anywho, so the triangle itself, the triangle pattern, that's, like I said, the one we're going to start with. It can be a continuation or a reversal pattern, but it's far more common that it is a continuation pattern. There are 3 types of triangles, 3 main types of triangles here. There's the symmetric, ascending, and descending. Now, for trading purposes, they are all the same. They just simply look different. A triangle itself, any one of these triangle patterns form when price action narrows over several price swings, meaning several swing highs and swing lows. If trend lines are drawn along the highs and lows of the price action that we're talking about, where price is moving, the trend lines converge towards each other. Okay, this is what should be happening if we're identifying a triangle pattern. This creates the appearance of the triangle, hence the name triangle pattern. These patterns occur in both uptrends and downtrends. Key word there. So we can see these patterns in both uptrends and downtrends. So whether the market's moving upwards or downwards, we can still witness these formations, which makes them versatile and it makes them quite usable. And they're not too difficult to find. Sometimes you won't see them for a little while, but they can present themselves pretty much anywhere. Since they can be continuation or reversal patterns, though, traders tend to wait for the breakout of the pattern itself to indicate which direction it's going. And we're going to talk a little bit more in depth about that later on when I talk about how we're going to set our take profit and stop loss levels based on these patterns. But it is important to understand that we're simply, just for the sake of simplicity, our entries will be coming after the pattern breaks. But since continuation triangles occur more often than reversal triangles, far more often in my opinion as well, but continuation triangles, once again, this is something you might want to take a note of. Continuation triangles occur far more often than reversal triangles. We focus more on breakouts to the upside during an uptrend, and we focus more on breakouts to the downside during downtrends. Okay, this is important, so I'm going to repeat it. It's important also because we tend to find more success with continuation trading than we do with reversal trading, and many traders will tell you this. So we want to focus more heavily on these continuation breakouts and be a little bit more excited about them when we do find them, because once again, the trend is your friend. You hear us say that all the time, and it is true, and it applies to this as well. So since continuation triangles occur more often than reversal triangles, we focus more on breakouts to the upside during uptrends and breakouts to the downside during downtrends. All right, that just simply means if we find a triangle pattern while the market's moving up, we prefer that the market breaks out of that triangle pattern to the upside to get in for that long. And if the market is traveling downwards and creating and drawing that downward triangle, we prefer that it break out to the bottom side in order to stay in that continuation manner. If the market's already moving downward, we want it to break out downward in order to stay with the trend, because the trend is your friend, right? Now, to draw a triangle, there simply needs to be at least 2 swing highs and 2 swing lows. Trend lines are drawn along the highs and the lows, those 2 swing highs and 2 swing lows that I was just mentioning, respectively, and extend out to the right. Okay, so we're looking for 2 swing highs to connect and 2 swing lows to connect, and we just draw them out to the right, obviously, as price moves to the right. The price may make a couple more swings within the triangle, and that's not a problem. We can redraw the trend line if needed to accommodate these new price swings. We know, folks, that the market is dynamic. It's always moving, and we want to be dynamic with it. We want to continuously be ready to adapt and give ourselves a more accurate image of the market as the market itself is providing us a more accurate image. We don't want to get stuck into that feel that we connected this swing high and this swing high, and now all of a sudden this is the only way the market can ever be. No, as the market ebbs and flows, we want to ebb and flow with the market. Okay. So, but when the price moves above the upper trend line, it signals that price is likely to move higher. The pattern is complete if price moves above that upper trend line. So that is in and of itself the breakout that we're talking about. Okay, if price drops below the lower trend line, it signals that price is likely to continue dropping. So that would be the breakout, another breakout that we're talking about as well. And ideally, what we would like is during a pre-existing bullish trend, while the triangle is already working its way upwards, we prefer that it does break out the high side, in which case we would expect it to be going upwards. So that's an example of a long. And if the price is working its way downwards overall, meaning the generalized trend, and we do break out to the downside, then we're going to continue to expect price to go to the downsides. However, this is not the only way that a triangle can be can be traded. Okay. Now I was already saying we do prefer to look for triangles, look for bullish triangles during a bullish trend that are breaking out bullishly when we're going long. Although it doesn't have to be that way. You can have a triangle that is working its way upwards during a bullish trend and break out to the downside, and we will still expect the market to break and move, or if it has broken to the downside, we will still expect the market to fall. We will still take this as a bearish signal, and it can still be traded. That would be an example of a reversal, however. Okay, that'd be an example of a reversal if the market was moving upwards and then we broke to the downside. I'm going to go ahead and shift the charts here so I can draw on some blank screen. So let's see what we've got here. So this help you guys follow along a little bit better. Let's move these charts out of the way right there. Okay. So just right off the bat, what I'm talking about. So if we have, say the market is working its way upwards. Okay, the market's going this direction. Okay, we're working our way upwards, and the triangle that we have formed. Okay, the triangle that we have formed has looks like this. Ting, 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 ting. If it breaks to the downside, meaning it finally crosses over and it breaks to the downside, we are still going to expect price to fall, despite despite this being a reversal situation. However, we strongly favor this type of a scenario. We have the market traveling upwards. Okay, so we have a bullish trend, and then finally, price breaks to the upside. Okay, and now we're expecting price to go up. It's important to understand that regardless of which way the pre-existing trend is going, the most important indication here from the pattern is which direction it breaks in. So whatever direction the triangle breaks in is the expected direction. However, we strongly prefer that direction to be in the direction of the pre-existing trend. So we want it to be a continuation, not a reversal. That doesn't mean the reversal can't be traded, but we just don't like it as much. We don't find as much success with it, but it is still very much so possible and still tradable, and many traders still will. Okay, so that's the simple side of things. Okay, but next we're going to draw what price looks like during these three different types of triangles. Earlier I was saying that there are three different types of triangles. So I'm going to try to draw them out the best I can so you can have great examples of what they look like. My lines, guys, we're just simply going to, obviously I'm not going to draw specific candles. Just the location of price is just going to be illustrated by the lines that I'm drawing. And it's just a trajectory of price, if I can get my words right there. And I'm going to do my best to draw off all these. We're going to start off by looking at a symmetric triangle, I suppose. We'll do that one first. We'll do a symmetric triangle, and we'll talk about what it looks like and what a breakout out of it would look like as well. So to begin with, I'm going to just start drawing price here. All right. So we'll say that we have price going up here, but down here, up here, down here. And then we kind of ping off of this. Maybe we travel this way a little bit. Maybe go up here a little bit. But ultimately, price kind of works its way up here. And we fall down. Right there. And we work our way back up here. And then we fall back down. And we work our way back up here. Maybe we don't quite make it to the bottom, but we work our way here. Fall down, not quite making it to the bottom. And then we work our way back down here. Okay. All right, so to the naked eye right now, all you're looking at is a weird zigzaggy line. So, but the idea was that initially, let me make this look a little bit more. There we go. Okay, so our initial trend direction at this point, we've got a bearish trend going on right now. So we have price working its way downwards. Okay, price overall, if you just follow the white line, if you're just locating price, it's crashing. Okay, we got price going downwards. At this point, we found a little bit of support and price kind of pinged upwards, but this trend itself was found downwards. Then we kind of more or less were moving sideways. Now, the portion of this that's going to be the symmetric triangle, those of you that have have some strong eyes, you probably already identified it. But we're gonna start here. Now, remember, we want to always connect at least 2 swing lows and at least 2 swing highs. So let's see if I did that. Okay. Oh, look, what do you know? We have that. Okay. And remember, triangles are generally just moving sideways. Okay, despite having a trend. All right. So looks like we've got a pretty good symmetric triangle. I'm not an excellent artist, but I'm pretty happy with what I've got drawn here. So we have an example where symmetric triangles are created when both trend lines, okay, see the top and the bottom, both trend lines are moving towards each other. Okay, and as you can see, they are. See, the top trend line is slowly getting lower. That means our swing highs are progressively getting lower, and our swing lows are progressively getting higher. So price is kind of squeezing, right? All right. So we've got a situation where we've got all of our swing highs connected, we've got all of our swing lows connected, and we can see that by the trend line, it is symmetric in nature. Despite my lack of wonderful drawing skills, we're essentially symmetric. The angle of incline of the swing lows is very, very similar to the angle of decline of the swing highs, and they're just converging towards each other, and we're seeing that price is just getting squeezed. The distances between all of these swings is getting lower and lower and lower. Now, because we were in a pre-existing bearish trend, okay, just because this pattern happened to be moving sideways temporarily, we are in an overall downtrend in this wonderful world of drawing. Ideally, we would love to see price break out here. Okay, we'd love to see price break out here and go downwards. We'd love to see this. We'd love to see price break out. Now, this is what I'm talking about, a breakout. We've got our trend lines connected, just like using any other trend line. A break is going to happen when it finally moves and price is trading below the trajectory that it was creating. So ideally, we would love to see price break out and then look to go short in this situation when trading the symmetric triangle. However, if price, say it pinged off of there, okay, it pinged off of there and then went for a breakout up here, okay, and now we'd be expecting price to actually be rising, okay. So this is an example of a symmetric triangle and which way we'd be looking to trade it depending on how it closes out the triangle. If it's closing out the bottom side, we're looking to short. If it's closing out the top side, we're looking to long. But because the overall trend was bearish in and of itself, we strongly prefer this situation here. We strongly prefer the selling opportunity. We strongly prefer to sell during that bearish trend, that bearish break. It's a much more strong signal for us if we get that bearish trigger during an already existing bearish trend. Okay, so that's ideally what we want, but that's an example of a symmetric triangle. And once again, symmetric triangle is created when both trend lines are moving towards each other. Okay. Next, we're going to talk about an ascending triangle. Now, an ascending triangle occurs when the lower trend line, let's erase this off the charts and we'll get ready. We'll get back to that, you know, my awesome drawing skills that I have here. But an ascending triangle occurs when the lower trend line is rising while the upper trend line is horizontal. And the idea is this shows that the swing lows are rising, but the rallies, those swing highs, are stopping near the same resistance level. So let's see what that looks like, okay? So we're going to do the same thing. We'll do another bearish trend. So market, think, 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 think. So down, down we go. All right. Now we're going to swing upwards here, perhaps. We're going to ping down. All right, we'll say here, I'm going to ping upwards again. And then we're going to swing down. And we're going to ping upwards again. And then we're going to swing down. And we'll do one more time for good measure. Pinging upwards one more time. And maybe market travel sideways a little bit. Okay, so what we have here, once again, we have an example of price moving downwards. We have a bearish trend pre-existing. So pre-existing bearish trend. Now what's going on here? Let's outline this pattern with our trend line. So we'll use white because white just popped so wonderfully. But I changed my mind. Let's keep it. Let's do blue. We'll do sky blue. That's a pretty color. So essentially, we've got our bottom trend line by connecting these points. We can see that the swing lows are progressively rising, but what's going on with the swing highs? Look at that. The swing highs, not so much. Not so much. Swing highs, we'll extend this a little bit farther. Swing highs, not so much. We're in a situation where price has kind of been pinging into this same situation. But the swing highs, there's not really an angle there at all. Now, if you slightly see one, once again, I'm not a perfect artist. Just bear with me here. The idea is that these swing highs are more or less stuck at a resistance. Say we were finding resistance. We look over here to the right, and it happens to be, say this is 1.692. There's a powerful area of resistance there, and that's what this is. And all of these swing highs are hitting the same generalized location, where on the bottom one, they are noticeably not. They're noticeably getting higher and higher and higher. Now, unlike the symmetrical triangle, only one side actually has a degree of change. The top side, obviously, is more or less flat, whereas the bottom side is rising. This is an example of an ascending triangle. Why is it ascending? Because the swing lows are progressively getting higher. Okay, the swing lows are progressively getting higher, and this top is more or less is stuck at the same location, so it's not changing, but the only direction that is changing is getting higher. Okay, this is an ascending triangle. Now, a swing high in and of itself, or I'm sorry, not a swing high in and of itself, the ascending triangle in and of itself, once again, if we're looking to break out of this, we're looking to trade it in whatever direction that breakout occurs in. So if we break out of the top side, if price works its way up here, and we break out of that top side, we're going to be in a situation where, let's see, let's draw this thing shooting up here. Okay, this is in a situation where we are going to expect price to rise. However, we know that the pre-existing trend is upwards. I'm sorry, is downwards, bearish, pre-existing bearish trend. So we would prefer that what actually happens is, ooh, we didn't want that. We'd prefer that price actually comes down here and breaks out lower. And we would have a situation in which price is falling. So now we're looking for the short during a bearish trend. This situation here is far more ideal, far more ideal. That's what we want. That's our perfect scenario, the best case scenario. If we saw this in the market, we're getting excited. It looks like we've got a great short opportunity coming up. Nice ascending triangle during a bearish market, but still breaking out bearishly, strong bearish trigger, definitely looking to sell. Okay? So ascending triangle, once again, difference is we've got a flat top, but our lows, our swing lows, are getting higher. Okay, the same theory is going to apply to all of these. Whatever direction the triangle breaks in is the direction we're going to expect the market to go. However, the direction we'd prefer and our strongest trades are going to come from the breakouts that happen in the direction of the pre-existing trend. That's the number one thing I want you guys to remember, so that's why I'm going to keep repeating it. Next, we're going to talk about our third and final triangle pattern, which is going to simply be the descending triangle. So we talked about a symmetrical triangle. We talked about an ascending triangle. So naturally now we have to talk about a descending triangle. We'll change it up for this one, and we're going to do it. Let's do it during a bullish trend. Okay, we're going to do it during a bullish trend. So a descending triangle is nothing more than it's when the upper trend line is sloped downwards while the bottom trend line is horizontal. So we're just going to reverse basically what we were just looking at. So say we have price traveling upwards. Tink, 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 tink. Price is traveling upwards. Okay, we're going up. Tink. And maybe we go down here. All right. I'm going to swing down here. Okay. Come back up here. Swing down here. And come back down here. And this might be a little bit of a smaller one, but you guys are going to get the idea. So pre-existing trend that's going on right now is a bullish trend. So once again, we have a bullish trend here. So market's working its way upwards. Upwards we go. We've got a bullish trend in progress here. But what do we have? What do we have but pattern where our swing lows are more or less horizontal, getting stuck at the same area. In this case, it's support because the market's sitting on top of it. It's traveling down to it, finding support, changing direction, going upwards. Price is unable to break below this point. Overall trend is bullish. We're going to connect our swing highs. Here we have connected our swing highs. And we have a pattern where our swing highs are progressively getting lower while our swing lows are sitting at the same point. Okay, so swing lows are getting lower while our swing highs are sitting at the same point. We have declining swing lows, but we have declining, I'm sorry, goodness gracious. We have declining swing highs, but our swing lows are at the same exact point. So this is our descending, our descending triangle. Okay, now once again, whatever direction the market breaks in is going to be the way that we expect the market to go. So if the market breaks the bottom side, the support level, okay, well, then we're going to expect the market begin traveling downwards if it breaks the bottom side. Even though it is a bullish trend, that would be an example of a reversal. However, what we really want is we really want this market to go up here and whoop, blast through the roof. We want her to travel upwards, in which case we're now going to be looking for that sweet, sweet long opportunity right there. Looking for that sweet long opportunity to travel upwards and ride the market with the direction of the pre-existing trend, with this new bullish signal, the fact that the market has finally broken out of this pattern of declining swing highs, and ride the market upwards. Okay, so that is a descending triangle. So we've seen a symmetrical triangle, we've seen an ascending triangle, and now we've seen a declining triangle, a descending triangle. Descending is the correct way to word that, by the way. But yeah, a descending triangle. So once again, important thing to understand with these triangle patterns is whatever direction it ends, it ultimately breaks in, is the direction we're going to expect the market to go. However, our strongest signals and our strongest trades are going to come from the times that it breaks in the direction of the pre-existing trend. Okay. Now we're going to talk about price target. So we know how to get in at this point. I've kind of nailed it in your head. We know how to get into the market. The idea is to get in after the break. During all of this, all of this hoopla over here, all this stuff that's going on, we don't care about any of that besides we're just paying attention to it. We're not actually using this in the terms of trading for triangles. That is, if you find a trade for another reason, that's great. But we're looking for an entry the moment this happens. We're basically waiting for this crescendo. We're waiting for the climax here. We're waiting for the market to finally break this pattern, and we're looking to utilize the expected increased volume and that we expect to be added to the market at the time of that break. All right, that's the idea. So the triangle pattern is a nice, easy pattern because it kind of builds up over a long period of time. Obviously, it depends what time frame you're looking at, but it kind of builds up over a nice long period of time, and you kind of know exactly when to always get into it. And that's going to be when you finally have that break. So we've got that break in this situation. Let's see if we can, here, let me erase this. We erase that. So ideally, we'll use this descending triangle that I've already got drawn, so I don't have to draw another one. We're going to take a look at this. So we've got a situation here where if this was a live example, and I think this is what I'm going to use because it's just too perfect, and I'd rather build you guys on a very strong foundation than make things a little bit more confusing if I find a live example that's a little bit not so perfect. We'll start from perfect and then we'll veer off from there. But we've got a descending triangle where our pre-existing trend was bullish. So ideally, we're hoping the triangle breaks to the upside. And what do you know it did? So we have a break where it kind of rockets up to the upside. If we take a look at this, maybe price falls back down. We can look for opportunity to get in there during that little swing low period. But the market is, we'll say it does this and it just kind of flies its way up. All right. Our take profit goal and our stop loss goal is what we're going to be discussing now. So we already know how to get in with all of these patterns, but I haven't talked about where we're going to set our take profit, and I haven't talked about where we're going to set our stop loss. Stop loss is going to be set. This is very easy. Stop loss is, we're simply going to set our stop loss just outside the bottommost trend line in this case. It's always going to be outside the opposing trend line of the break, just outside the opposing trend line of the break. That means bottom blue line is our opposing trend line in this case because we broke to the top side. That means my stop loss can go right here. I mean, that's actually pretty darn close, but ideally somewhere around here, okay? How far below that trend line you're willing to set your stop loss is going to be determined by how conservative or aggressive you want to be. But once again, the idea is to set our stop loss somewhere, ideally, just outside, say right there, okay? So stop loss location is going to be set just outside of the bottommost opposing trend line, obviously. In this case, it is bottom, but the opposing trend line. That's all we have to remember. If it was reversed the other way around, it would be the other way around, okay? So in this situation, our stop loss would go right near all these red lines, somewhere in there, okay? And our take profit goal, this is where it gets fun. So our take profit goal is going to be based on the distance between the base of the triangle. So the distance between the base of the triangle, when we start drawing this triangle pattern, if we look to the left, back where we started drawing it, the widest portion of the triangle will always be on the left. Okay, if we have a triangle pattern, it will always be on the left. So the distance between the widest portion of the triangle, so say right here, all right, we'll use yellow to measure this one. All right, so between here and here, okay, is our widest portion of the triangle. All right, it's from one swing low to the first. It's from our first swing low to our first swing high. That is representing the drawing of this triangle. So the distance between here, all right, say this is, say we're on the euro dollar right now. Say that's 20 pips. Okay, just picking a number. Say that's 20 pips. Well, then our take profit goal that we're going to be looking to set, ideally, we're going to expect this market to break and travel upwards, perhaps right here. Say that's 20 pips, okay? So the distance between this spot and this spot should be the same. Now, the take profit goal during a bullish uptrend and a break of the triangle, it doesn't have to travel only that far. It could keep going a lot farther. Maybe it goes shorter, but this is just a very good generalization of where we would expect price to go and where a lot of traders will set a take profit goal. They'll use it. They'll say, okay, if the distance between the widest portion of the triangle, the base of the triangle, if the distance between the base of the triangle is 20 pips, then maybe they'll set themselves a goal of, say, 17 to 18 pips, just to be, if they want to err slightly more on the conservative side. If they're going to be real bold, then maybe they're going to go for exactly that 20 pips, or maybe they're going to go a little bit farther. But the generalized idea here is we're looking for an expected move that's the width, okay, that's the distance of the base of the triangle. So we'd be looking to set our take profit goal, or we would have been filling our take profit goal in a perfect world right here, okay? And we would have traveled upwards, gotten in for our long, and traveled upwards, okay, from our entry to this take profit goal, okay? And there we would have had a successful position. In this case, once again, this would be an example of a bullish trend where we found a descending triangle, but we broke out bullishly, which is ideal, and we rode it upwards into the moon. And we got an idea where to set our stop loss just based on going just outside the opposing trend line, just outside the opposing trend line of the break. Remember, we broke to the upside, so that means the opposing trend line is just going to be the bottom one. Had we broken to the bottom side, then we would have set our stop loss just outside, okay, just here, right? Just outside. Let's mark that off with a red line, actually. So had we broken to the bottom side, that's not red. Had we broken to the bottom side, we would have been looking to set our stop loss somewhere right around here, okay? If we broke, that's assuming we broke right here, okay? So had we broken the bottom side, then this would have represented our stop loss location, but the same thing would have applied for our take profit goal. We'd still be looking to utilize that take profit goal. Now, we don't want to be blind, obviously, while we're trading these patterns. We don't want to, say there's a very strong area of support right here, okay? We always want to take that into consideration with these take profit goals. That's just good trading practice. Okay, but this is just generalized concept and ideas. All right? So we've got a great example. We've talked about 3 different types of triangle patterns, how to trade them. We talked about how the take profit goals can be set and how the stop loss goals can be set. And once again, this applies to all of them. All of the 3 that I've already drawn, this applies to all of them. Remember, it doesn't matter which direction the market breaks in. We're going to expect it to go in that direction. But when it breaks in the direction of the pre-existing trend, those are our strongest and most favorable trades. And remember, our stop loss, we're looking to set it just outside the opposing trend line of the break. We're looking to set our stop loss just outside the opposing trend line of the break. All right? And our take profit goal is going to be set by just simply looking at the base of our triangle, looking at the distance between the base of our triangle, and expecting the market to move in whatever direction it breaks in, that distance in that direction. Okay? Very simple stuff, good stuff, but solid information, and we can get a lot of beautiful trades just simply by paying attention to some of this stuff. Okay, just market moves, some technical analysis. Here we go. All right. So with that covered, take a breath here. Actually, I'm going to grab a little bit of water, make sure my voice doesn't crack. There we go. Now we're going to take a look at some wedges, shall we? We're going to take a look at wedges. All right, we're going to cover some wedges. Now, wedges is going to be easy. We're going to kind of breeze through this because wedges are very similar in every concept that we were just discussing. Very similar to triangles in the way that they're traded. Okay, so this getting through wedges is going to be much quicker than what we were just doing here with the triangles. All right, so I'll actually leave this on screen while we're talking about them for now, but I'll end up taking it off so I can draw some wedges. Okay, but taking a look at wedges, wedges themselves are a multiple price wave. Now, once again, guys, back to taking some notes here. And here, I'll just wipe this. I'll wipe this. We'll move back a little bit. Move back a little bit. We'll change my mind. I don't want to confuse anyone there. So, wedges themselves, guys, time to take a couple notes again, and then we'll draw some stuff. Wedges are a multiple price wave reversal pattern. Okay, multiple price wave reversal pattern. Wedges are a multiple price wave reversal pattern. All right. Wedges waves of an asset move within a narrowing range angled either upwards or down. So this is a key thing here, guys. Wedges form when waves of an asset move within a narrowing range angled either up or down. So we have a directional heading that's expected of a wedge. Okay. Whereas triangles, like we were just talking about, are formed by price moving sideways. Okay. That's the difference between a triangle and a wedge. Outside of that, pretty much everything else is very, very similar. Okay, so once again, triangles, like we were just discussing, they're essentially moving sideways. All right, that's a triangle. It's moving sideways. Wedges are moving upwards or downwards. Okay. When the pattern completes and price breaks out of a wedge, it is usually in the opposite direction the wedge was pointed, which is why it's called a reversal. Okay, that's why I was just referring to it as a reversal pattern. Okay, for example, if a wedge is angled downward, meaning the entire pattern itself is traveling downwards bearishly, called a falling wedge, okay, correct term would be a falling wedge, then price will often break above the top of the pattern and then rally. So if we've got price falling downwards, price is bearish, moving downwards, it's expected that the wedge is probably going to break to the upside and rally, which is why we generally look at a wedge as a reversal pattern. Whereas with triangles, we're usually expecting them and hoping that they break in the direction of whatever the pre-existing trend is because they're a sideways moving pattern. That's the only differences there. But the price will often break above the top of the pattern and rally in the case of a falling wedge, and it'll do the opposite in a wedge angled upwards. Okay, a rising wedge, correct term, a rising wedge when you have your pattern traveling upwards, the breakout is generally to the downside, indicating price is about to get lower, a bearish signal there. So while price is rising upwards, forming a wedge, we're expecting it to break to the downside and reverse and start crashing. Okay. We draw a wedge by connecting multiple swing highs with a trend line and then connect the swing lows with another trend line. Okay. Same way essentially that we're drawing our triangle. Okay. We're just connecting swing highs and swing lows. And during a falling wedge, we watch for price to move above the upper trend line. Okay, so if the wedge is falling, we're hoping that it moves above the upper trend line, and that would signal the breakout, and that completes the patterns. And we'd be looking for a long in that situation. And then in a falling wedge, obviously, it'd be the other way around. So, or I'm sorry, in a rising wedge, it'd be the other way around. So when price is rising, we've got a wedge rising. We're hoping that it eventually breaks the downside trend line. And then all of a sudden, we are looking for a short with expectation of price to fall as a reversal. So let's go ahead and draw some of these. I feel like drawing them is just a great way to create a visual representation of this stuff and kind of hammer it in. And I like drawing it. Even though I'm not a great artist, I am actually enjoying drawing these because I feel that it's allowing us, it's given us a way to create these custom yet perfect examples of what these, as close to perfect anyway, of what these wedges and triangles should look like. And if you start with a strong base, then you can always go from there. So, but all right, so we will do, let's do a falling wedge, shall we? So with a falling wedge, we're going to look at something like this. So we're going to see prices. Whoop, hold on a second. All right, so prices up here, all right, downward. Let's see, downward, 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 downward. Okay, there. Okay, downward. We'll go here. Go up. Go downward again. I'm trying to get these to line up as perfect as possible, folks, but yeah, we'll go upwards again. Go downwards. Maybe we fall straight down this time. Right. And go upwards one last time. And downwards one last time. Okay, and we'll actually add an extension to this somewhere over here. Okay. Not as pretty as my triangles, I'm just going to say that right out of the gate, but anywho. So we have a situation here where, once again, just like the triangles, guys, we're just going to connect our swing highs. We're going to connect our swing highs, okay? We're going to connect our swing highs here, and we're going to connect our swing lows, okay? I didn't start my wedge as wide as I probably should have, but it is a wedge nonetheless. We've got a situation where price is widest at the outside, okay? Widest at the outside and getting tighter as she goes. And this is a falling wedge, okay? This is a falling wedge. So we've got price traveling downwards between between a tightening channel, essentially, where our top trend line and our bottom trend line are progressively getting closer. They're not doing it in the same exact angle, and they don't need to be. This isn't a symmetrical triangle. Once again, this is a wedge, okay? This is a wedge. So we're working our way downwards, falling wedge. Now remember, because we consider wedges to be more of a reversal pattern, we would ideally like that price, goes, let's change that back to white. We'd ideally like that price goes down here, maybe pings up and then breaks out. So we want the breakout to happen to the upside in a falling wedge, and we're expecting price to rise thereafter, okay? So same thing here, okay? Same thing here. We're same as a triangle. Whatever direction it breaks in is the direction we're going to expect price to move in. However, with wedges, we prefer that it's a reversal, okay? With a wedge, we prefer it's reversal. And remember, a wedge happens going upwards or downwards. Wedges don't go sideways. Whereas triangles, obviously, like you saw in my drawings, they are traveling themselves sideways. So wedges upwards, downwards, and we consider them reversals. So whatever way it breaks in is the direction we're expecting. So at this location over here, we'd be looking for our long, and somewhere in that green circle, preferably, looking for our long, looking to ride the market upwards. Okay. Now I'm going to draw a rising wedge, and then we'll talk about some profit ideas and goals with them. So let's go back to drawing that. Let's see if I can draw a better rising wedge, shall we? So let's say that we've got price. We'll say it starts. We'll start it here, go down quite steep, and we're gonna ping way over to here perhaps. How about that? Maybe go here, right back up there. Fall down quite steeply, say like right about there. And we kind of work our way back up over here. We'll do it with a few bumps in between, make it a little bit more complicated here. Fall, but we'll do it like that. Okay. Go up here again. Get some more bumps along the way. And hit down here, and then ping into the top one more time. Okay. So I tried to make this one a little bit more complicated to show you the dynamics of it, but here we have, once again, another wedge. Now, when I outline it with a trend line, it's going to become a lot more apparent, all right? And this is why you got to practice this, because you should be able to see these without having to draw them, but obviously drawing them is going to help. So here we are, all right? So we've got a situation in which we have a wedge, all right? We're channeled upwards. We're setting ourselves upward. This is a rising wedge, okay? Rising wedge. We're working our way upwards. We are progressively getting tighter. Once again, I didn't probably make it as tight as I wanted to, but it doesn't matter. It's a wedge, okay? It doesn't have to reach a crescendo. That is a key thing, and I don't know if I said that yet, but if I didn't, then I'm saying it now. Remember, a wedge does not need to reach a crescendo. It does not need to come to an endless point. We're just looking for the point at which it breaks out. Wedges tend to be longer-term patterns. Okay, wedges tend to be longer-term patterns. So it might be in that wedge for quite a while before it finally ends up breaking. All right, but same thing applies here. So once again, we've got a rising wedge, which means ideally we're hoping that it breaks to the downside. Okay, ideally we're hoping that it breaks to the downside, and we'd be looking for some short opportunities. Okay, looking for some short opportunities. We'll be looking to sell the market during that break, somewhere right there. And we'll be anticipating the market to fall. That's a rising wedge. Market was moving upwards, so we're looking at it as a reversal pattern, and now all of a sudden it's broken, and we're looking for the market to fall. Now, okay, stop losses. Okay, we'll start with stop losses because that's pretty much exactly the same as our triangle patterns. Okay, stop losses set with wedge when we're trading wedge patterns is just outside of our opposing trend line. It's exactly the same method we're using to set our stop loss levels when we're trading the triangles. Okay, so if we broke to the downside in this situation, our opposing trend line, obviously our opposite one, is going to be up here. So we'd be looking to set, okay, so if we broke here, all right, we're just going to follow that directly upwards. That means we're going to be looking to set our stop loss just outside of that, say right there, okay? So just outside the opposing trend line, we'd be looking to set our stop loss. So somewhere right up here in this zone, we're looking to set our stop loss, okay, where all those red lines are, all right? Stop loss goes there. All right, now our entry point, obviously, as we already talked about, our entry point, I made it red because it's a sell, but our entry point is this thing here. Okay. It was supposed to be green. There we go. So somewhere around here, we're looking to get in. Okay, looking to enter the market for a sell, looking to enter the market for a short. But this brings us to our next topic. Now, where is that take profit goal going to go? Where's it going to go? With the wedges, it's not so cut and dry, so to speak, as symmetrical, descending, all of our other triangle types. It's not, at trading triangles, we have an idea. We just measure the base. Wedges, because they're not working to a crescendo, it's not a sideways moving pattern. We don't do that. With a wedge, because it tends to be a longer term pattern, like I was saying, wedges, they can be significant turning points in the market themselves. So a breakout may see price run in the breakout direction for a long period of time. Therefore, it isn't a long-term price target that we set for a wedge. Rather, the pattern gives us an analytical insight into where price is headed and an entry point into what could be a large move. So with wedges, we're more so looking to simply get into the market, have an idea of where we want to get out of the market, but we're kind of looking to ride it for the long haul. We're trying to look to ride it as long as we possibly can. Obviously, we're still going to pay attention to other things like, say, we have a strong area of support right here. Say there's a strong area of support, we're going to look to ride the market and be aware and be cognizant of all these other areas where the market might stop and reverse at. But a wedge, we don't have an expected goal and then it's do this, that, and the other. We look at a wedge as a strong, because we look at them as reversals, we look at them as a strong turning point in the market and a just overall change in the dynamic of the market itself. We were in a buying market before, now we're in a selling market with this particular example. So we're looking to take advantage of that and hopefully ride it as far as we can until we personally feel that the market has run out of momentum. So this is something that's going to come with a little bit more experience. It might be a little bit scarier to you new traders, but it's also exciting because we're looking for longer term moves, longer term trades when trading these wedges. Okay, so wedges, once again, we look at them as a general direction heading in complete change of the overall direction of the market, and as such, there is no just minimalistic take profit goal. Instead, we usually keep that take profit goal a little bit wider and just ride it as it goes and feel it out. Okay, all right, so good stuff, good stuff, good stuff. Now, if I have answered a couple questions as we went along organically, but if anybody has any other questions about trading triangles, any of the three different types of triangles, or wedges, now is a great time to ask them. So I'm going to give you guys a second to type up any questions if you have any. But if you don't, you can say anything else in the chat box you want to. But yeah, if you don't have any questions or you feel you understand what I'm talking about, then you don't have to ask anything. That's no problem either. I'll take that as a sign of we have reached an understanding on wedges and triangle patterns, how to trade them, how to set entries, how to place entries based upon them, where we expect the market to go when they happen, what they look like. We have hit the end of the road, folks, in terms of this lesson. Not the end of the road for you. This is just the beginning of the road for you, because what comes next is you take this information to those live charts. You start looking for these lines. You start practicing drawing from all these swing highs, and you start giving yourself some insight into where that market might be going, just with the information of a triangle and a wedge pattern. Very powerful stuff and very easy stuff. People are always looking for this magic indicator, when a lot of times there's some magic in simplicity. So it looks like everyone's on the same page. That's awesome. I did enjoy this. This webinar in and of itself. Hopefully you guys did. But other than that, folks, thank you for joining me again for a beautiful Monday webinar on triangle and wedge patterns. I will see you soon, as I am always doing those daily market recaps for you guys. And I'll see you back here again when we cover our next topic on Monday yet again, of course. But thank you guys for joining me again. It's been a wonderful lesson, and I do look forward to seeing what you guys can pull off with your newfound knowledge and understanding of these wedge and triangle patterns. But other than that, best of luck. Happy trading, everyone. Over and out. Have a great Monday, guys.